Hi there, it's Stephen Thomas with Reports on Housing, and I'm coming to you recording this on Thursday, September 4th. It's September already, and we're bringing you another housing debrief, and this week we're going to focus on what are the signals? There are signals that you can look out for looking at a housing crash. And because so many people are talking about it, it's like it's nearly 50% of the population thinks prices are really going to come down. And there are a number of people across the United States that really feel that home values are going to crash. And let's get into it and look for those signals. And first, we're going to talk about the Freddie Mac House Price Index. We look at the Freddie Mac House Price Index, but there's a number of home price indices to follow. It's not median sales price; it's a more accurate depiction of where prices are going. There's Case-Shiller, there's ICE, formerly Black Knight, there's Freddie Mac. That's the one we're using here. Zillow has one. There's a number of them across the United States that where they have this home price index, but we like to follow home price indices. They're very, very similar. They're all following a very, very similar pattern, and it's a little bit better than the wonkiness of median sales prices. This is a bit more accurate. So this is Freddie Mac's house price index, and we're going to show you what's happened to rates. To housing values over the years. And you can actually see that there was a big run up in values after 1999 into 2000, all the way up till we hit the Great Recession. And so there was a big buildup in housing prices that was unprecedented. And then after that, what happened is we ran into the Great Recession and we started to really peel off value. And you could actually see the value coming down here. But then after the Great Recession was pretty much done, in 2012 began the expansion years of the housing market again, and you could actually see how much it elevated. And then you hit COVID and the pandemic, and interest rates that were low, 17 record low interest rates. The Fed brought interest rates down to 0%, and you could see how there was just this gigantic climb in skyrocketing values across the United States. So as a result, we've seen values come down, and you could actually see that values came down initially in 2022, and this is where people thought, this is the beginning of the end. But that was a lot of people that were thinking we're going to have the Great Recession, thinking like Great Recession. But the issue was there weren't a lot of people that were really in pickles. There wasn't all those junky loans that fed the Great Recession. So as a result, we saw in 2023, after the last 6 months of 2022, in 2023, we saw values going up again. And it seesawed around during the fall. It typically is going down a little bit, and we're seeing that again. And that's kind of where we're at right now. It's kind of flat if you see that up at the top. And really what we have here is what is referred to as an affordability crisis. And it's because after those 17 record low interest rate cuts, or in those 17 record low interest rate levels that we reached, and the last one, it was starting in COVID, and the 17th was reached in January of 2021, and we were at 2.65% interest rates across the United States. That was really low. And then since then, it kind of was floating around the threes and got up to right about 3% in December of 2021, and then started to rise. I think the average for 2022 January was 3.45%, and then it just kept on skyrocketing after that, creating an affordability crisis because it eclipsed the last time we had a five handle, 5% interest rate was back in August of 2022, which is now over 3 years ago, 37 months ago that we last had an interest rate in the fives. So it's been an affordability crisis where we've been stuck pretty much between 6.5% and 7.5%. Yet today, as I am recording this on September 4th, it is the lowest. It's the lowest level in interest rates since October 3rd of last year. So we've actually dipped finally below 6.5%, making our way down a little bit below 6.5 in the upper 6.4s. So that's where things are at, but there still is an affordability crisis. And what constitutes affordability? there are three prongs to affordability, and it's mortgage rates. This is where a lot of people have been around a long time said, I used to have interest rates of 10, 12, 18%. Doesn't matter because you match that up with where home values are today and incomes, and that's where you get affordability. It's not just where mortgage rates are, it's where home values and income are. So household incomes factor into this, home values factor into this, and mortgage rates factor into this. And really what everybody's been calling out is that mortgage rates aren't changing much. Incomes are going up, and they've recently been outpacing. The inflation, but nonetheless, home values have gone up a little bit over the last several years as well. So overall, there hasn't been much improvement as far as the affordability crisis that we are currently enduring with these rates that are stuck right around 6.5% on up. Finally, a little bit below that. But now there's a lot of people out there, and I have people that ask me this. I have people that comment on this. I have a lot of people that say, yeah, but Stephen, you're not talking about the reversion to the mean. And this is like fancy talk. And when people start talking like that, people are thinking, yeah, this guy's got a point, that values should come down to where they should have been if they continuously go up in time, the way that values go up in for real estate over time. And you could actually see in this. This is what they mean by mean reversion. And this is the mean taken from 1976 to where we are today. And you can see that sometimes it's below it, sometimes it's above it. And you could see when we were in 2010, 11, 12, 13, it was well below it and slowly made its way up till we hit COVID. And then ever since then, way higher. Now, what they mean by mean reversion is that this line, these home prices should come back down to that line. And wish it was that simple. That's the way a mean reversion happens with a lot of stocks and different things like that, and happens in other economic sectors, but it doesn't necessarily happen for real estate. Real estate is a different asset class. It's not the assets that are traded on Wall Street. It has a lot to do with housing supply and building zone requirements. There really is some structural long-term upward trend in real estate. So it continues to go up over time, and it doesn't go up at the exact same clip. There are different factors that go into it. It's this big structural difference between housing and other assets. And then there's real supply constraints too, as well, with this housing supply that slowly moves. It doesn't change really fast over time. You can't all of a sudden say a whole bunch of people want it, so we're gonna build it all. That's just not how it happens. And then we have building zone and persistent issues with building enough properties anyway. So there really is a supply constraint problem in the United States, and it's been like this for quite some time. And so you're wondering, okay, so then what are the different things that we should be following? What are the signals that we should be looking for? What's the data we should be looking for? First, let's bring in our sponsor, and I'd like to thank our sponsor. And this week it is Mike Grambow from JMJ Financial with the Thibodeau Morel Group. You can reach Mike at 714-794-7668. That's 714-794-7668. And they have a great product. He has a number of different non-QM loans that are people that don't fit the necessary, they're like a square peg and a round hole, so they need a different product out there. They're for borrowers who do not meet the usual guidelines. And these are real estate investors, real estate agents, self-employed borrowers. He has loans that are 12-month bank statement programs, 1099 only programs, no income DSCR loans for investment properties. And they have exciting alternative loan products. They have income from the P&L without further documentation of bank statements, tax returns, or pay stubs. They need a letter from the borrower's CPA verifying the P&L as well. And they can close as fast as 14 days, both purchase and refinance. And so contact Mike Grambow at JMJ Financial with the Thibodeau Morel Group, 714-794-7668. And now back to the program. And, so what are those signs that you should be looking for, those signals that there's there's not any one signal that will indicate that we're going to have a housing crash, but we watch a number of signals, and if a lot of them are showing, that means that there are some deep concerns, a lot of red flashing lights, and so these are the check boxes that you want to look for if you are looking for the various signals that illustrate that there's an issue within housing. And so the signals that you should be looking for are there's a lot of data that you can follow that is released. Some of this stuff is done on a monthly basis. Some of it's released weekly, and some of it is released quarterly. And one of the things that you want to follow is a waterfall dive in demand. And we actually have had a waterfall dive in demand. You can see, I'm showing you, this goes back, this National Association of Realtors United States Pending Home Sales Index that goes back to January 2001. And I'm showing you the last 3 years. And actually the second half of 2022 is the beginning of that dive. And each of these hills is a year. So you can see 2023, 2024, and in this year so far, 2025, those look really muted. And it's actually a little bit more muted than over here where it's the Great Recession and prior to the Great Recession. And what this was very, very muted demand, as well as you could see a spike there. That spike in pending sales was actually the first-time home buyer tax credit that was going to expire, which is why you got a spike for the month, because you had to be in escrow during that time period. So all of a sudden you had this big gigantic spike. And but embedded in a lot of these pending sales and that pending home sales index were a lot of short sales that didn't close too. So you have to take that with a grain of salt, but it is a little bit higher if you look at it, sheer numbers compared to where we are within the last few years. So it's definitely been muted demand. And that is one of the things that a lot of people are indicating as the biggest factor why, because this has to do with affordability, that values should fall. And it is definitely a red flashing siren light. And another thing that you should be watching is the soaring national delinquency rate. That's what you need to have happen. You need a soaring national delinquency rate. And this is where delinquencies are right now. You can see right now it's at 3.35%. And yes, it's a little bit higher than where we have been over the last couple of years, but we also had a moratorium on foreclosures. We did, even though we had a moratorium on foreclosures, we did have national delinquencies. We're including the people that went into forbearance. So it's actually been very, very low. And so it's still really strong. It's making its way back up towards pre-pandemic levels, but it's not even there yet. We're going to see a rise, a little bit of this in FHA, and that's pretty much along the south. There is a chunk of the United States that this affects the most, Louisiana, Oklahoma, and Mississippi being a few of those states. This is 4.27% is where the 5-year average prior to the Great Recession. You can see the national delinquency rate that is right now is still really low compared to where we were in time. So we're not having this soaring national delinquency rate. We're not going to have a lot of delinquent properties. That is something that this trend that we're following, that the trend is not really going to change. Too healthy of a housing stock. Another thing you need to see is soaring inventory. And if you look at recent soaring inventory, if you squint here, you can actually see on the right-hand side that yes, we have a lot more inventory than we have had over like the last several years. But in 2022, the lowest level ever, you could actually see that it was really low. It was the all-time lowest level. And even though where we are right now is higher than where we've been over the last few years, it's still there's not enough homes across the United States, 1.55 million homes across the United States, versus where we hit 4 million homes or nearly in 2006 and hit it in 2007 and in 2008. So that was a glut of homes that were available. So we had way too many homes, and it soared. It got there really fast. It started in 2005. By the time we got to fall of 2005, we hit 3 million homes. Then we got up to 4 million homes. But it's one of those things that it doesn't happen overnight, but it is some trend that we follow. And right now, this is not a trend that it's showing that it's continuing to soar up higher. We're actually probably peaked at about 1.55 million where we are right now, and it'll start to come down and trail down for the rest of the year. That's the way each of these years work. Like I was saying earlier, that the change in the housing supply is really slow, and it will be one of those leading indicators that we'll be able to see if there's a problem. And we're not even close to a problem. We haven't even made our way back to pre-pandemic levels. Then we have loosening credit standards. And so when it gets loosey-goosey out there, and I keep on hearing examples of loose credit standards, and that's not what it is. Even if there are special non-QM loans that they have, there are still some stringent qualifying, and the lenders aren't going to bite off on it unless it's somebody that really qualifies with the program that they have. So there are still very strict lending requirements, and we can see it here that this is where we are right now. And yeah, it might be a little bit elevated compared to where we were in the past, but you have to squint to see any elevation. Yes, it is a little bit larger, but when you compare it recently, it shows a little bit more elevation. But when you compare it to where we were prior to the Great Recession, and even during the Great Recession, it didn't get down to that line until 2008, when already everything was falling apart. So that's where you see this mortgage credit availability was pretty much anybody could get a loan. And we're not even close to that. We have Dodd-Frank that was enacted in 2010, and it makes it so that everything is completely transparent. We don't have the kind of loan products that we had prior to the Great Recession. They just don't exist today. And then another thing to follow is spike in unemployment claims. And you can actually see, if you look at this, you'll hear some people say, this is initial unemployment claims. This came out this morning on September 4th, and it's for the prior week ending August 30th. So this is not really a spike. It was an elevation. It didn't mean much. It was higher. It did move markets a little bit, but you got to take this with a grain of salt. This is the highest since June of this year, and people were thinking there was a problem back then, and then it came back down, and then we're not really hitting these initial jobless claims where it's anything that's really of a concern. Because now when you go back in time and you see all the jobless claims in time, you could actually see that spike during COVID. You have to pull it off this chart because it was so high. There were so many people that went on unemployment all of a sudden because we shut down the economy. So this is just that you could see it in recent times. You can see where it is now versus prior to the Great Recession and during the Great Recession, where it was really elevated. And that was where there was over 300,000 initial unemployment claims. We're not there. If you remember, we're at 237,000. We're not at 300,000. And that's really where the concern would be if we were consistently at that mark at 300,000. And and by the way, the purple solid line is the 4-week moving average, because this kind of is very volatile from week to week. It's the aggregate of unemployment claims. And you could see here that we're not even close to that 300,000 level where we would have some sort of a concern. And then you could see actually continuing unemployment claims. This actually has risen quite a bit since July of 2022. You could see it, that we were even below 1.4 million. And now we're making our way kind of, it's stuck, not quite there to 2 million, but that's where it's at. But this too, you have to take with a grain of salt. This is the context that a lot of people are utilizing, but you have to look at it over time, which is what we do. This is the geekiness and nerdiness of when you go into looking at all the analytical data. And if you see, this is where we are right now versus this is where we were prior to the Great Recession. And you can see that where that level is, it's right about 2.5, and we're not quite to 2. So we're still well below that. And that's prior to it even getting higher. And even earlier in the 2000s, you could see it was elevated, making its way up towards 4 million. So we do have unemployment, long-term unemployment claims are rising. However, it's not rising where it's any kind of red light yet. And elevated bankruptcies is something else that we watch. And if you look at it in the scope of something as small like this, a small chart, this is taken out of context once again because it looks like it's elevating and it's growing higher and higher. And it looks like, there's a trouble spot. But then if you look at it, this isn't the prettiest to look at, but this is the same data. You could see the red, ignore the foreclosures in the blue, but the red is our bankruptcies. And the reason why there's a waterfall dive in bankruptcies in 2021, in 2021, I'm hilarious. At the beginning, at the end of 2005, beginning of 2006, is because there was a change in bankruptcy law. But you still got it was still elevated prior, even with that change, it was elevated prior to the Great Recession and then continued to grow before and during the Great Recession. So like I said, we're not really seeing anything that's a red flag here either. Poor loan credit scores. So if there's a lot of lending that's being done and they're just doing whatever, fog and mirror type of loans, that's something else we need to watch. And you can see this is the mortgage origination by credit score. This also is done by the New York Fed. It's just an aggregate of all credit scores. And you can see that the blue is 760 plus. And pretty much the vast majority since the initiation of Dodd-Frank in 2010 is we have a lot of blue, a lot of people with high credit scores. And there aren't a lot of people that have credit scores below 659, that's orange, or that dark blue. But if you look over here, boy, there were a lot of them that were done. And that was the lead up to the Great Recession, and even at the start of the Great Recession, still far too many. And that's why they initiated Dodd-Frank, so that we could have better lending standards. And that's part of why we have such a healthy housing stock. So you need to follow a lot of data and continue to watch this data. There are a lot of data points to watch. And I know that there's a lot of people that say, but my gut says prices need to come down. It's more of a supply and demand issue right now. You're seeing some values go down in some areas a little bit, and it has more to do with supply and demand. A little bit more supply than we've had over the last several years, and all of a sudden it's starting to balance in the favor of buyers slightly, and that's why you see values come down. If all of a sudden interest rates continue to go down, that will add more demand, which will recalibrate that, and it will probably, if we get down to 6% with duration, it will line up in the seller's column, because demand will start to really increase at that point. So that's what it is. So you're not going to, even though your gut says prices need to come down, that's not the way housing economics works. And there's a lot of people out there that are chicken littles, constantly talking about how the sky is falling. And they've been wrong for a very, very long time. And they have websites and they have organizations devoted to this, YouTube channels, TikTok, Instagram, and they're all over X. But that, even though they say these things and they point out different things, that doesn't mean that it's going to happen. And I can show you that here. There was somebody actually put this together, and this was Case-Shiller U.S. Home Price Index, and this was back in 2018, talking about how we were going to crash. It was housing bubble 2.0. That was in 2018, prior to the giant run-up. And if anybody believed them back then, they really missed out on a ton of equity if they would have purchased. So unfortunately, there's a lot of people that sound like they know what they're talking about, and then they write articles like this. Everybody clicks on them, they believe them, and some people, they have the wrong expectations because they're not listening to the aggregate of all the data and listening to the people that are truly analysts of housing like ourselves. And there's a lot of people like us across the United States. If you like this video, please like the video, as well as subscribe to our channel. Go to reportsonhousing.com for more information. Subscribe. And the stretched dollar, that's the most recent one that came out this week, and it's just talking about how people's dollars have been stretched with inflation, as well as in rents, as well as in values going up, and then on top of that, throw in higher interest rates, and their dollars are really being stretched if they're trying to purchase a home. So if you want a free month, utilize the coupon code SIGNALS. We have housing reports that dot all over SoCal, the Bay Area, as well as Phoenix and Vegas. And so I just want to thank you for joining us for another housing debrief. Hope you have a fantastic first week of September, and hope you have a great weekend, and we will see you on the other side.